Hello everyone, I hope you all are well. I am Rupali Paul. Now I am going to discuss about J-curve effect. Hope this video will be helpful to you. First of all, I am going to discuss about J-curve. A J-curve is a trend line that shows an initial loss immediately followed by a dramatic gain. In a chart, this pattern of activity would follow the shape of a capital J. Our next topic is the J-curve effect. From the graph, we can see that the performance is below the original level for some time. After some time, it starts increases above the original level. The J-curve effect is a depreciation in the exchange rate can cause a deterioration of the current account in the short term. However, in the long term, demand becomes more price elastic and therefore the current account begins to improve. Now, we will see the sequence of events followed by a J-curve effect. The first one is currency depreciation. Initially, when a country's currency depreciates, its exports become cheaper for foreign buyers and imports become more expensive for domestic consumers. Second one is short-term trade imbalance. In the short term, the country may not see an immediate improvement in its trade balance. This is because it takes time for consumers and foreign buyers to adjust their behavior in response to the changing relative prices of imports and exports. Third one is time lag in adjustments. There is a lag between the currency depreciation and the responses of consumers and businesses. It takes time for consumers to shift their buying habits towards domestic goods and for foreign buyers to increase their purchases of cheaper exports. Fourth is long-term improvements. Over time, as consumers and businesses adjust to the new price levels, the trade balance is expected to improve. Exports increase, imports decrease, and the trade deficit diminishes. The J-curve effect is often used to explain why a country might not immediately benefit from a currency depreciation in terms of an improved trade balance. It highlights the importance of considering the time it takes for economic agents to adjust to new exchange rates and price levels. Additionally, the J-curve effect is not always granted, as it depends on various factors, including the elasticity of demand for a country's export and import and overall economic conditions. So now we are discuss how J curve is related to the Marshall-Lerner conditions. The Marshall-Lerner conditions are given by Alfred Marshall and A.P. Lerner. It shows the relationship between price elasticity of demand for export and imports and its effect on the country's balance of payment situation. The J curve is related to the Marshall-Lerner condition, which states if PEDX plus PEDM greater than 1, then a devaluation will improve the current account. The J-curve is an example of how time lags can affect economic policy. It also shows the link between microeconomic principles and macroeconomic outcomes. In the next, we will discuss about the graphical representation of J-curve. Assume that a country's CAD is a X and the government lowers the exchange rate. The price of export will fall, but communication is not perfect and will take time for other countries to realize that the prices in the country has fallen. Also, other countries will have entered into contracts for goods and services that cannot be broken quickly, so they cannot change their suppliers immediately. The short-term effects. In the short term, a fall in the price of exports will only cause a smaller percentage rise in quantity demanded. A rise in the price imports will cause a smaller percentage fall in demand for imports. Therefore, the value of imports actually rises. Therefore, if demand is inelastic following a depreciation, we actually get a worsening of the current account. Long-term effects. In the long term, demand for exports and imports will tend to become more price elastic. Therefore, a fall in the price of exports will cause a bigger percentage rise in quantity demand. When demand is elastic, the value of exports rises and we get an improvement in the current account position. Also, if demand for imports is price elastic, then there will be a bigger percentage fall in demand for imports. In this case, the total spending on imports start to fall. We have reached our last topic of slide, which is the reasons to explain J-curve effect. The J-curve effect can be explained by several economic factors that influence the adjustment process following a currency depreciation. Here are some of the key reasons for J-curve effect. One is time lags. When a country's currency depreciates, it takes time for consumers and businesses to adjust their behavior. In the short term, they may continue with their existing consumption and investment patterns. It can take months or even years for them to adapt to the new price levels and switch to domestic products or increase exports. Price elasticity of demand. The responsiveness of consumers and foreign buyers to changes plays a significant role. If demand for a country's export and imports is inelastic, a currency depreciation may not have an immediate impact on the trade balance. Over time, as consumers and businesses adjust, the elasticity of demand can change, leading to improved trade balances. Contracts and agreements. Many international trade contracts and agreements, such as long-term supply contracts, may have fixed exchange rates or prices that are not immediately affected by currency fluctuations. Inventories. Businesses may have existing inventories of imported goods that they purchase at the previous exchange rate. As long as these inventories are sold off, the full impact of the currency depreciation on imports may not be felt immediately. Speculation. Currency traders and investors may anticipate future exchange rate movements and take positions accordingly. Their expectations can influence short term exchange rate movements. Competitiveness. A currency depreciation can enhance a country's export competitiveness, but it may take time for businesses to reconfigure their operations and take advantage of this newfound competitiveness. Income and wealth effects. A currency depreciation can lead to change in the real income and wealth of consumers and businesses. These changes can influence their consumption and investment decisions, but the effect may not be immediate. Capital follows. Um, Currency depreciation can also affect capital flows, which can have indirect effects on the trade balance. For example, a depreciating currency might attract foreign investment in the country, which could partially offset the improvement in the trade balance. In summary, the J-curve effect results from a combination of factors, including time lags, the price elasticity of demand for goods and services, the nature of international contracts, and the adjustment processes of economic agents. These factors contribute to the delay between a currency depreciation and the eventual improvement in a country's trade balance. Thanks to everyone for listening me.